We are now going to talk about foreign exchange. We'll discuss some definitions, the notion of an exchange rate, the nominal exchange rate, appreciation and depreciation, and then we'll move on to discuss a little bit theories of exchange rate determination, with exchange rate determination in the long run, purchasing power parity, then the theory of exchange rate determination in the short run, which is demand and supply. To begin, a nominal exchange rate is the simple rate at which two currencies exchange with each other. Now, this exchange rate will be different depending on the nature of the buyer and seller. So a tourist buying a few pounds before making a visit to Britain will get a less favorable exchange rate than a business that can offer to exchange millions of dollars. Here's a screenshot of a phone app which gives nominal exchange rates at the tourist rate for a particular moment on a particular date. So what you see here is that we have set the app to value one British pound in terms of different potential currencies. Now this app lets you choose the currencies you are valuing. And £1 can exchange for 1.4612 US dollars, 1.3150 euros, and so on. So this is actually a really good and intuitive way to present the exchange rate for a British pound. As a purely practical matter, when you as a tourist go to the airport, let's say, and you want to exchange some currency, often the rates of exchange are expressed in terms of fractions. That's a little hard to work with. When expressing exchange rates in terms of fractions, typically the little currency booth will have one column which it says is the buy rate and another column of ratios, exchange rates, it says is the sell rate, and it can be a little awkward figuring out which one do we mean. Am I the buy rate or the sell rate? When expressing an exchange rate as a fraction, it's imperative to be really clear which currency is in the denominator and which currency is in the numerator. Now this app that you see here, it's clear that you can think of it as having ratios where one British pound is in the denominator and the numerator is the corresponding value of the foreign currency, like the US dollar. So if we have a rate for the British pound expressed as dollars US divided by pounds, then the US dollar has depreciated and the pound has appreciated. If that ratio increases. If that ratio decreases, then we say the pound has depreciated and the US dollar has appreciated. So when one currency increases in value, by definition, the other currency has decreased in value. Now, one thing that may surprise you is that for regular people, we imagine that demand and supply for foreign exchange, foreign currency, is driven by the need to buy goods and services abroad. Actually, the volume of trade in foreign exchange markets is much greater than the amount of trade in goods and services. And the reason that's true is because financial traders think of foreign currency not simply as a means of payment, but also as a sort of asset that can be used to store wealth, sort of like a stock or a bond. Now we're going to move on to the discussion of theory of determination of exchange rates. Why is it that different currencies have different rates of exchange? What's called the theory of purchasing power parity predicts that in the long run, exchange rates will reflect the different purchasing power of different currencies. So that if the British pound buys twice as much of every sort of good and service in the world as the US dollar does, then we would naturally expect that in the long run, the British pound will be worth about $2. A pound is worth twice as much as a single US dollar. Now, the reason why this should be true is the principle of arbitrage. Arbitrage is essentially the idea that traders will trade currencies in such a way that they have made the maximum possible profit. And arbitrage means that if a tradable liquid asset or tradable good have prices that are inconsistent with competing assets or competing goods, then there'll be a profit motive to buy the unusually cheap item and sell the unusually high one. And with trade across borders, especially in foreign exchange, being very free and easy, this will lead to an equalization and a rationalization of prices across borders. Now, currencies have prices in terms of other currencies. If, let's say, for the sake of argument, the British pound was trading at a 1-to-1 ratio with the US dollar, and the British pound bought twice as many goods and services per pound as a single US dollar did, then traders could make an easy profit. Instead of using US dollars to buy goods and services, what we could all do actually is convert our dollars into pounds, and then immediately we could use those pounds to buy twice as many goods and services than if we had stayed with dollars. However, this sort of free lunch, if you like, will not last very long, because as we all rush to buy pounds with our dollars, we would drive the value of a British pound up to the point where it costs $2 to buy a single British pound, at which point there is no more pressure on the purchasing of pounds. We have a sort of consistency between the way we value in foreign exchange the two currencies and the value we get from the two currencies in terms of the goods and services we can buy with them. So to summarize, purchasing power parity is a theory that says in the long run, exchange rates reflect fundamental differences in purchasing power between currencies. Now, behind this purchasing power parity idea, there are a lot of assumptions. One assumption is that trade in currencies is perfectly free. Without free trade in currencies, arbitrage is not going to be working. Another more subtle assumption is that every international currency can be used to buy every sort of good or service in the world. And that's obviously not true. So we don't expect purchasing power parity to work perfectly. But it's still reasonable to say that relative purchasing power for currencies that are freely traded in the world should not be wildly inconsistent with their relative purchasing power. So if you're living in a country with a currency that is experiencing a hyperinflation, so a single currency unit buys very little in terms of goods and services, it does not make sense that this currency should trade one-to-one with the US dollar, for example. I've talked about the long run determination of exchange rates. What about the short run? Well, in the short run, we're going to assume that supply and demand determine the value of currencies, and we will make the following assumptions. Currency values are determined by supply and demand. Currencies are demanded because they are necessary to purchase goods and services. And currencies are also demanded to buy government bonds. So a foreigner who wants to buy US Treasury bonds will need to pay for those Treasury bonds using US dollars. And currencies are also demanded to buy other sorts of national financial assets. So if you want to buy US corporate bonds or US corporate stocks, you will need US dollars to purchase those things. We'll also assume that currencies can be viewed as a form of wealth storage, which implies that international investors are keeping portfolios that include currencies as one of the items in the portfolios. And finally, on the supply side, we'll assume that different central banks can increase or decrease the supply of their own national currencies as they like it. And without getting into the detail, the US Federal Reserve can increase the supply of dollars in the world as much as it likes. It can also decrease the supply of US dollars in the world as much as it likes. Exactly how that works, we're not going to talk about right now. So let's use one really simple example. Think of a demand and supply diagram like you learn in principles of economics. Now, the thing being demanded and supplied is not a good, it's a currency, the US dollar. And the supply of US dollars in the world is influenced by choices of the US Federal Reserve. So let's suppose the US Federal Reserve starts printing a lot of dollars. Then what's going to happen, I hope you recall, is that the supply curve moves to the right. The equilibrium intersection between the demand and supply curves implies a lower price for the thing being traded. And in terms of foreign exchange, that's like saying if the US Fed dramatically increases the number of US dollars in the world, it increases the supply of US dollars, and assuming everything else equal, like we do with demand and supply, then what should happen is the price of a US dollar in the world market falls, that's like saying the US dollar will depreciate against the British pound, for example. The analogy would be, for example, if we're talking about the world price of coffee and we're in equilibrium, and suddenly the government of Brazil releases a huge amount of coffee that it has in storage onto the world market. Intuitively, we understand correctly that everything else equal, no change in the demand position of the demand curve, the world price, the global price of coffee from Brazil will fall. That's the sort of demand and supply story we're telling with the US dollar here. Let's take a more complicated example, and we're going to use something called the wealth effect channel. Imagine the US economy starts booming and growing, and people's wealth, their portfolios of assets increase. Now, since investors wish to have a well-balanced portfolio, they will be thinking about including foreign financial assets as part of that portfolio. So in the United States, the demand for foreign assets will increase. But in order to buy those foreign financial assets, like bonds and stocks, investors first need to acquire some foreign currency. So what will happen is the demand for foreign currency will increase, and you'll see that manifest by a rightward shift in the demand curve for foreign currencies. Now, this is one channel of effect. Typically, there are other stories we could tell about how growth in the United States would affect demand for foreign exchange. But typically in demand and supply, we have to keep everything else equal. So, wealth effect, increased demand for foreign financial assets like foreign bonds and foreign stocks. In order to buy those foreign bonds and foreign stocks, United States investors have to acquire foreign exchange. That means an increase in demand for foreign exchange. That means in the foreign exchange market, people will be using their US dollars to try to buy more foreign exchange. And that will cause an appreciation in foreign currency, and the US dollar will depreciate a little bit. This demand and supply diagram illustrates the wealth effect story I just told you. And what I'll do here is use British pounds as a representative of foreign currencies generally. So what you see here is an increase in financial wealth in the United States has caused United States people, United States investors, to try to acquire more British financial assets. In order to buy those British financial assets, investors in the United States first need to acquire some pounds. They need the pounds to buy the British financial assets. That's why there is a rightward shift in the demand curve. Now, as we move to a new exchange rate, ER1, what's happened is dollars divided by pounds has increased. So let's imagine in the denominator we have 1 British pound. The numerator has increased. we need more US dollars to buy a single British pound. So British pounds have appreciated, then necessarily relative to British pounds, the US dollar has depreciated. So this is a graphical representation of the wealth effect story. Here's an example of a graph showing the change in rate of exchange of the British pound against the US dollar at a particular point in history. And you look at this diagram and you know immediately it has to be dollars in the numerator and pounds in the denominator. It has to be that because the values are all greater than 1. So since we know a pound is worth more than a US dollar, it's got to be that the dollars are in the numerator. That's why you get the 1.42, 1.41, etc. And what you notice is that over 2 days you can get a significant change in that ratio. What causes the change in the ratio in this particular case is news about the campaign for Britain to leave the European Union. And when the probability of Britain leaving the European Union seemed high, the pound fell. That's that big dip there. When there was more news that showed the probability of Britain leaving the European Union had decreased, it was more likely that Britain would stay in the European Union. Traders liked that news, and so the value of the British pound increased. So this is the sort of reaction that foreign exchange markets have every second of every day, 24 hours a day, in reaction to any kind of news pertaining to the state of the different global economies. Okay, see you in the next lecture.